Blockchain. It sounds like the newest heavy metal rock band to me sometimes, but this is actually an innovative technology application that you need to be familiar with for your exam day. You may or you may not have heard the term blockchain before. So what is a blockchain? Blockchain is a type of digital database or ledger that provides proof of who owns what at any moment in time, because each transaction has been added to the ledger. Okay, are you still confused after that definition? Let me explain some more and give you an example. Let's start with the ledger. The ledger in blockchain is a type of distributed ledger that's encrypted, public, and shared widely for anyone to view. Every transaction makes the ledger grow larger. Don't you think this concept is similar to the general ledger in accounting? Every transaction will be recorded as a journal entry and then posted to the general ledger. The more journal entries, the bigger the general ledger. Now, in addition, since the ledger is distributed, data can be accessed by anyone, and therefore no central administrator is required. So how's the blockchain formed? Well, obviously we need chains and block. It's called a blockchain. Each chain represents each transaction, just like a journal entry. For example, a company performed a service but had not yet received payment from the customer. The company would record a journal entry by debiting accounts receivable and crediting service revenue. This entry is considered a chain. Now let's switch to the term block. A block is the current part of a blockchain. It records some or all of the recent transactions and becomes a permanent database in the blockchain. Now, continuing with our example, assume the company performs services 5 times during the year. There should be 5 journal entries for the recognition of accounts receivable and service revenue, resulting in 5 chains. Each of the entries will increase the balance of accounts receivable. Now let's assume there was no payment received during the year. The year-end balance of accounts receivable will be the total amount of those 5 entries. In other words, the ending balance of accounts receivable, or the amount in the accounts receivable ledger, can be considered a block. Blocks and chains form the blockchain. Each time a change in a block occurs, a new block will be formed and linked to the old block by a new chain. Each change should be authenticated by miners. So, how does blockchain affect or change accounting? Normally, the users of financial statements could only see the end result for the operations of the company. It may be hard to discover a secret change in the subsidiary ledger. However, with the mechanism of blockchain, each change of the company's financial statements, even though it's a slight change, should be verified by miners and form a new block. Now, it's much more likely for a company to fairly and timely present its financial statements, resulting in the achievement of the objectives of financial reporting.